On a quiet morning in late 2023, something extraordinary happened in the global financial system. Something invisible, silent, and yet powerful enough to send tremors through the world's biggest economies. It began when the central banks of China, Russia, India, Brazil, and several Middle Eastern nations executed a series of large-scale international payments without using a single US dollar. No SWIFT network, no American banks, no Washington oversight. These transactions were conducted through new digital corridors, alternative payment systems, and currencies that Washington could not influence or control. For the first time in decades, a group of nations tested a world where the dollar was not the only option. And the global order felt it. The markets didn't crash, no alarms rang, but deep inside the US Treasury, the Federal Reserve, and Wall Street's billion-dollar trading floors, analysts saw it clearly. They watched as financial liquidity subtly shifted. They tracked how oil deals were increasingly settled outside the dollar. They monitored the quiet expansion of digital currencies built by emerging economies. And they all asked the same question: is the world preparing to move beyond the American dollar? For nearly 80 years, the US dollar has ruled global trade, global banking, and global economics with overwhelming dominance. It became the world's reserve currency after World War II, not because it was forced on nations, but because America was the only economic superpower left standing. The world needed stability, and the dollar provided it. With the Bretton Woods Agreement, Washington built a financial architecture that touched every corner of the planet. If a nation wanted to buy oil, it needed dollars. If a country borrowed money from international lenders, it borrowed in dollars. If central banks wanted to store safe reserves, they held dollars. The dollar wasn't just a currency, it was leverage, power, or influence and control. But today, the world is changing. Slowly at first, then faster. And now, almost suddenly, the cracks in the dollar's dominance are widening. What was once unthinkable is now being discussed openly in parliaments, central banks, newsrooms, financial forums, and geopolitical war rooms. Nations are asking whether the global economy should continue to depend on a single currency controlled by a single government. They are wondering whether it is time to rebalance the scales of power. They are questioning whether the dollar has become a risk instead of a refuge. Because the truth is, the world has changed in ways the architects of the post-war system never imagined. The United States still has the largest financial influence, but its economic dominance is no longer absolute. China has become the world's largest exporter and the second largest economy. India is rising at breathtaking speed. The Middle East is building independent financial blocks. Africa is becoming an emerging global powerhouse. And dozens of nations are frustrated with a system where one country's domestic policies can shape the financial fate of the entire planet. Every time the US government prints trillions of dollars, every time Washington sanctions a country, every time the Federal Reserve raises interest rates that cause debt crises in poorer nations, the world is reminded of one reality. Dependence on the dollar means dependence on American decisions. And that dependence is starting to look dangerous. It began subtly. Nations started signing small trade deals in local currencies. India bought oil from Russia using rupees. China and Brazil settled major transactions using yuan. Saudi Arabia accepted payments in multiple currencies. The UAE and India built an entire payment system that bypassed the dollar entirely. Iran, Russia, and China strengthened their digital currency networks. The European Union explored strategic autonomy. African nations launched cross-border digital settlements. South American countries proposed a shared currency. And BRICS, once a loose economic forum, became a global counterweight preparing to challenge the world's financial core. The US dollar didn't fall, but it tilted. And the world noticed the tilt. The dollar's power comes from confidence. Confidence that the US economy is stable. Confidence that the American system is trusted. Confidence that the dollar will remain valuable. But confidence is fragile. And in recent years, confidence has been shaken by events Washington could not hide. High inflation, massive debt, political division, repeated government shutdown threats, bank failures, global backlash from sanctions. a rising sense that American leadership is less certain, less steady, less predictable than before. When nations feel uncertainty, they begin searching for alternatives. And today, alternatives exist. China is pushing the yuan. BRICS is developing its own digital currency. Dozens of countries are building regional payment systems. Cryptocurrencies are redefining how people store value. Central bank digital currencies, CBDCs, are transforming how governments manage money. The world is not replacing the dollar yet, but it is preparing for a world where it is not the only pillar holding up the global economy. What makes this shift so dramatic is not that the dollar is being attacked. It is that the world has outgrown a single currency system. Globalization diversified supply chains. Technology accelerated interdependence, and political tensions fractured alliances. The world became multipolar economically, but remained unipolar financially. And now, the gap is widening to a breaking point. If economic power is shared between many nations, why should financial power remain concentrated in one? The answer is simple: it shouldn't. And that is why the dollar's dominance is slowly weakening, not because America wants it, but because the world wants change. For decades, Washington used the dollar as its greatest diplomatic weapon. If a country defied U.S. interests, the American government restricted access to dollars. If a nation fell into conflict with U.S. allies, Washington cut it off from the SWIFT network. The sanctions system became one of the most powerful tools in modern geopolitics. But every sanction had a cost. It pushed nations away from the dollar. Russia built an alternative. Iran built an alternative. China built an alternative. The Gulf began exploring alternatives. Even longtime allies began questioning whether the global financial system should depend on a currency that could be used against them. This was not a plot. It was a consequence. Nations don't like being cornered. And the more Washington relied on sanctions, the more the world began quietly preparing escape routes. What makes this moment historic is the convergence of three forces. First, geopolitical tensions between the U.S. and rising powers are accelerating efforts to build independent systems. Second, technology has made it easier than ever to transact globally without needing American banks or networks. Third, the world's emerging economies are growing faster than the old powers, and they want a financial system that reflects this new balance. When BRICS expanded, it became more than a group. It became a global bloc representing the majority of the world's population, massive natural resources, and enormous economic potential. When China internationalized the yuan, it created the first serious competitor to the dollar in modern history. When dozens of nations began exploring digital currencies, they created a future where financial power could be shared, not dominated. Yet, the most powerful force weakening the dollar is not geopolitical. It is mathematical. The United States owes over $34 trillion in national debt. It spends more than it earns. It prints more than it produces. And every time Washington raises the debt ceiling, the world sees the same warning. A system cannot sustain dominance forever if it is built on borrowing from the future. The dollar is not collapsing, but it is evolving from the world's unquestioned master to one of several global pillars. This does not mean the end of American influence. It means the end of American exclusivity. But power never shifts peacefully. Whenever a dominant currency weakens, the global system enters a period of uncertainty. Investors panic. Nations reposition. Markets fluctuate. Trade flows reorganize. And beneath all of this, there is fear. Fear that if the world moves too quickly, the financial architecture will shake. And if it moves too slowly, the imbalance will worsen. The world is standing at a crossroads where every decision matters. Should it remain tied to a system built 80 years ago? Or should it build a new financial era where power is distributed more evenly? The answer will shape the next century. The quiet truth is this: the transition has already begun. The question is not whether the world will move beyond a single reserve currency. The question is how long the transition will take and what will emerge on the other side. The shift away from the dollar did not begin with a grand announcement. It began with a whisper, a quiet decision in a small ministry office, a subtle change in a central bank ledger, a discrete agreement between two nations trading goods without involving a single American bank. These tiny cracks accumulated over decades, until one day they became too big to ignore. Because the world finally saw that the global financial system had become dangerously unbalanced. One nation, no matter how powerful, could not permanently control the financial lifeline of nearly every country on Earth. And as new powers rose, as economies globalized, as alliances fractured, and as technology evolved, the world reached a silent conclusion. The dollar's dominance was not sustainable forever. The first major shock came when Russia invaded Ukraine in 2022. Overnight, the United States froze hundreds of billions of dollars in Russian reserves. Banks were cut off from SWIFT. Assets were seized. International transactions halted. For Washington, it was a strategic victory. For the world, it was a revelation. A revelation that the global financial system was not neutral. It was not separate from geopolitics. It was a weapon controlled by one government, one banking network, and one currency. Countries that once assumed their reserves were safe started looking at their own vaults with fear. If it could happen to a nuclear superpower, it could happen to anyone. Nations like Saudi Arabia, India, Brazil, Turkey, South Africa, Malaysia, and even US allies quietly asked, "What protects us if our interests ever diverge from Washington's?" The answer was uncomfortable. Nothing. And that is when the real shift began. Saudi Arabia announced it was open to selling oil in multiple currencies. China signed over a dozen yuan-denominated energy deals. India and Russia created a rupee-ruble settlement mechanism. ASEAN members explored ditching the dollar for regional trade. Africa strengthened the Pan-African payment system. South America revived talks of a shared currency. And BRICS accelerated its plans for a digital trade network. The trend was unmistakable. Nations wanted financial freedom. But breaking free from an 80-year-old system is not simple. The dollar dominates because it is liquid, trusted, and globally integrated. Every major bank uses it. Every financial system supports it. Every commodity market prices in it. The dollar's power is structural, embedded in the world's economic DNA. Yet even the strongest structures weaken when the foundation begins to crack. Inside the US, something else was happening. Something even more dangerous for the dollar's long-term stability. The national debt was exploding at a pace no economist had imagined possible. Years of war spending, stimulus packages, tax cuts, bailouts, interest payments, and political dysfunction pushed America into a debt spiral. 30 trillion became 35 trillion. 35 trillion will soon become 40. No empire in history has maintained currency dominance while drowning in debt. Not the British, not the Spanish, not the Dutch, not the Romans. Debt destroys faith, and faith is the only thing holding the dollar above all other currencies. At the same time, inflation hit America harder than expected. For ordinary people, prices rose drastically. Housing, food, fuel, interest rates, loans, everything. For foreign governments holding billions of US dollars, inflation meant something worse. Their savings were shrinking in real value. Their reserves, stored in dollars, were silently eroding. Their wealth was bleeding without warning. What happens when people begin losing trust in a currency? They diversify. They look for alternatives. They move slowly at first, then more confidently as others join. That is exactly what the world is doing now. Meanwhile, China prepared for this moment for 20 years. With every infrastructure project, with every Belt and Road Agreement, with every trade partnership, Beijing positioned itself as the world's next financial anchor. It built its own version of SWIFT. It built digital payment systems. It internationalized the yuan. It negotiated currency swap agreements with countries across Asia, Africa, Latin America, and the Middle East. And quietly, it built massive gold reserves. More than any nation besides the US, gold is the ancient language of power. When nations accumulate it, they signal something. A preparation. A transition. A future where confidence is not placed in one country's debt, but in a universal asset that no government can print. But China was not alone. Russia increased its gold reserves drastically after 2014. India built reserves too. Turkey, Kazakhstan, Brazil, Egypt, Saudi Arabia all stockpiled gold at historic levels. In 2023, central banks bought more gold than in any year since 1950. The message was clear. The world is preparing for a post-dollar era. The most dramatic sign of this shift came in the form of a question asked by Saudi Arabia, a question that would have been unthinkable a decade ago. At the World Economic Forum in Davos, the Saudi finance minister was asked whether they were open to trading oil in non-dollar currencies. He replied, "Absolutely." That one word shook financial markets. Because Saudi Arabia is not just any country, it is the heart of the petrodollar system. When oil-producing nations price oil in dollars, the entire world must use dollars. And that system is what gave the US its extraordinary financial advantage. If Saudi Arabia accepts multiple currencies, the foundation of the petrodollar begins to crumble. And without the petrodollar, the dollar becomes just another currency. Not worthless, not weak, but no longer unique. America sees this coming. Washington knows the world is changing, but it also knows something else. Even if the dollar loses dominance, no single currency will replace it. Not the yuan, not the euro, not a BRICS currency. The future will not be unipolar, it will be multipolar. A world where several currencies coexist. A world where financial power is distributed rather than concentrated. This is why the battle is not just about currency. It is about control of the systems that manage currency. The platforms, the networks, the digital rails. China is building its own. Russia is building its own. India is building its own. BRICS is building its own. Even Europe wants independence from American-led financial oversight. Each system is a quiet rebellion against dollar dominance. But the most revolutionary development is digital currency. Central bank digital currencies, CBDCs, will transform the global financial landscape faster than any political agreement or military alliance. China's digital yuan is already active in over 200 million wallets. India's digital rupee is expanding rapidly. Europe is testing its digital euro. Even the US is researching a digital dollar, though political opposition remains high. Digital currencies move faster. They reduce transaction costs. They bypass traditional banks. They operate without SWIFT. And most importantly, they remove the dollar as a mandatory intermediary. This is the true threat to American financial power, technology. When trades can happen in seconds using blockchain-based systems, why would nations rely on a slow, expensive, heavily controlled system built in the 1940s? The future will be a world where trade happens through digital bridges that connect multiple currencies instantly. No need for a single global reserve currency. No need for a financial hegemon. No need for dependence. This is why the dollar's weakening grip does not look like a crash. It looks like a migration, a movement, a shift. Slow, steady, unstoppable. But here is the uncomfortable truth. If the dollar loses dominance too quickly, the world will face turbulence unlike anything we have seen in decades. Global markets will panic. Nations with debt in dollars will suffer. Trade routes will destabilize. Investment patterns will scramble. And the financial hierarchy will shake violently. That is why every major nation, from China to Saudi Arabia to India, is moving carefully. Slowly, but deliberately. The world does not want chaos. It wants balance, and balance is coming. The United States will remain powerful. The dollar will remain important, but it will no longer be the world's single pillar. It will be one of several pillars. Shared power, not singular power. A financial system that reflects the world as it is, not as it was in 1945. The real question is not whether the dollar is weakening. It is whether the world is ready for what comes next. Because once the transition is complete, there will be no going back. The global financial system will be rewritten. The hierarchy will shift. The future will belong not to the currency with the biggest army behind it, but to the systems, networks, and alliances that move money with speed, freedom, and trust. The new world of finance will not be imposed by one nation. It will be built by many. And in that world, the dollar will still be powerful, but it will no longer be alone.